Good afternoon, Scott Redler, T3 Live. Welcome to today's recap. So after 5 tight days of holding higher in the S&P, we finally had a little bit of resolution. We've been talking about the 8-day moving average, the 21-day moving average, the rotation amongst all sectors. And so far, there's been a lot to like. And you could say there's some things under the surface that are a little troubling. But all in all, you look at the chart of the spiders and you see, that we've had a slow, methodical move, okay? If you want to backtrack a little bit to where we were, after the correction that took place from October down into early November, here was that red dog reversal, here was that gap. From there, a really nice move up. Remember we drew this little downtrend right here. That's where we got some resistance. Here was that physical cliff. Talk and obsession and argument, boom. Here was New Year's Eve, your gap up. Okay, so just say you didn't want to take anything into the whole fiscal cliff debacle or obsession. This was your spot to put on some positions. This was your spot while we were digesting to get involved in the market, all right, or put some longs on. So if you were in just say tier 1 in this little spot, okay, all of a sudden here was your little 2-day move to clear this spot. That's when you sell a little bit. Then within this range, okay, when we were holding the 8-day moving average and some things were acting better than others, another spot to put on some longs, another spot to have a hedge on and cover into support and accumulate. And then once you get above this area, which is 147.28, I talked about it a few times, 147.25, into this extension, what you do is you add as it gets through resistance. And then once we were as high as 148, 148.42, that's when you take a little bit off. That's when you trim, what I would say. So, you say trim and trail, use a tier system, here you go. Tier 1, here's your tier 2. Back to tier 1. Get involved in the strongest acting stocks as we hold the 8-day. Back to tier 2 as we clear it. As we extend back to tier 1. Then all of a sudden, you're holding tier 1 of 6, 7, 8, 9 positions all the way from here. So with that said, you just caught a nice move as it were trending for about 2 weeks or so, and then you're adding cash flow right there, adding cash flow right there, and now we need to see what happens here. Do we build a new floor above this recent breakout and then continue above what has been the benchmark here, or the highs? Remember 148.11? Okay, the market tried to be a little cute and push you and fell there. It didn't have enough power to the downside to do so. But all in all, really nice action. Not blockbuster action, not fast and furious action, but enough to make money, enough that even yesterday, it was a little dangerous. And I understand because when I sent my note out yesterday and even this morning, I had like 13, 14 longs on and I had no short. Because I'm like, you know what? If I wasn't in anything, and I was just playing as an active trader to be involved in the spiders, if it broke out, I'd be buying the spiders. So I'm like, you know what? I'm going to go long the spiders alongside my 13, 14 positions or 12, 13, whatever they were. Try and play a breakout. So from 147 this morning to about 147.80, I was long the spiders to get some extra juice. Okay, then sold them. So on the people on the virtual trade floor, saw it leave. No longer was I long the spiders, nor was I shorted because I covered my shorts yesterday. Then, right around 148.25, 148.35, I'm like, you know what? I just, saved myself some of the, not say even pain, just some of my muted gains on my longs by having the hedge. And now I'm going to put the hedge back on because here we are. We broke out. We have a new range. I'll short into the upper end, trim some longs as they extend, hold some and trail some that I like, and continue to do that until the trend changes, until something really is blaring and saying, okay, be careful. Time to really back off, time to be, neutral versus neutral to positive. And if you go back to the chart here, it's been a very neutral to positive move in 2013, even starting way back from November 16th. I think we've been in some type of portfolio approach, 80% of this time as it's been, acting very, very well. So with that said, you never want to chase. You never want to fall asleep behind the wheel, or so to speak. And coming into these highs here, it's a nice spot to lighten up a little bit, and then see if we hold here, then go through with them. Then you have all of a sudden your 15, or your 100, your 1500, or your 150. I know you go to the weekly chart here, and it still looks really good. Okay, it's still looking to take this double top out, and then really your next resistance, which I don't know if it's going to be this quarter. I don't know if it's going to be next quarter, but here is at 152, okay, which is about 1520 in the S&P, and then here's that double top that I am anticipating at some point, whether it's this year or next year, the road to 1700, that this double top gets taken out and we wind up going to 1700. Right now we have a very nice, strong macro trend, in place ever since the lows back after the financial crisis, and as long as we continue to follow this, it pays to be bullish. Okay, it pays to have a portfolio approach. It pays to, trade these, intermediate trends that have been along the way. You could just even see them here, where we break, risk off, tail into support, risk on. You break right here, risk off. You tail into support, risk on. Here was another one where we broke. Here's the support, and you could also make alpha based on these intermediate trends that I've gone over many times besides the macro chart. So all of a sudden, here we are entering this resistance zone. We might not take it out the first time we get here, but I do think at some particular point, macro-wise, we take it out. So we go back to where we are today as far as different sectors, and it was a little concerning that the financials weren't involved today, even though Goldman was still strong. Some of them were okay. Bank of America, which traveled a far distance, broke its 21-day, not with velocity or force, but it did, so I stopped out of it just because that was my rule. I said if we stop out or we fell at 21-day moving averages, I'm going to get rid of some of my positions. Do I think that the high of the year in Bank of America is in? No. But I don't need to sit through the noise back and forth. I'll see another setup and we'll get back in another time. But right now, if you look at the XLF, here we are coming into some, very significant resistance. Okay, so it might want to pause here. Okay, so that's your longer term chart of the XLF. If you go to more recent, okay, which is what we've been really tracking here, okay, this has been above the September highs, well before the spiders had just got there, so you've seen your relative strength. This group as a whole is still following the 8-day moving average, okay, and if you wanted to have a tight stop, if we were to break this ascending channel, if we were to close below the 8-day moving average, if you want to sell some, you sell some, because there is a chance that we do come in and test the 21-day moving average. If you look at the, the trend that we've had here, since November, it happened actually ever since we really, took off. It's only happened once. So maybe when we do have some kind of pullback, it'll happen again. If you look even further back from the summer, once the trend got situated, it really only came in and tested it once as it went sideways. And then it had a peak, came in again. So right now, overall on a macro trend, starting even from the June bottom, we basically only closed below the 21-day here once with any kind of force to get you even out of it. But overall, again, look where we are. It's made it very easy for intermediate trend traders like me to hold, a bunch of financials or whatnot. And if you don't want to be involved, okay, if it breaks here, get out of the way and then see how we handle the 21-day. But if you get out of the way, like here, when we broke the 21-day, okay, and you said, oh, look at me, I got out of the XLF. I'm a rock star, okay, because we broke this trend here, which it did. So if you get out here, and as we're coming in, you feel all good. Oh, I got out. I have a great market timer. And you didn't get back in right here on this red dog reversal. All of a sudden, look where we are now. You had a great exit here, but you missed your entry. So if you are going to exit, if we do take this out, you better be sure to get back involved when you see some type of reversal, for higher prices moving forward, which I think we're going to have. And that goes to say the same with Bank of America. A lot of guys that got out right here, okay, are very happy about it. You know what? You got out at 1190 after a huge move all the way from 995. Congratulations, okay? And today, it pierced this area a little bit, so I got out of it because I think that there is a chance, okay? Some people are pointing out a head and shoulders formation here, with this being the left shoulder, this being the head, this being your right shoulder. So the neckline's 1130 to 12. So if you or what is this, 1220? So about 90 cents. So you take off 90 cents or so, and we might be able to come back in here and test the 50-day, which I do think will be viable. Here's a smoother trend line. So if you want to be perfect, because you sold here, all right, you want to make sure that you're rebuying it back at this area. Or even if you sold here, because you said, okay, I'm going to give it some space. You sold today, which I did, but make sure we get some type of reversal, some type of pattern into this area. You're buying it back. So at least if you want to make like you missed something or you saved something, because if it comes here and you don't do it, and then later this year it goes through here, you're going to be a little upset. Same thing happened to me with Yahoo. I thought I was, being really cute here, and basically, we all know that, 1660 is something I've been talking about with Yahoo. I said as long as it, holds the 8 and 21 day, I'm going to stay with it, and it looked really good. Here's when it closed below the 21 day. So I got out of it. I didn't get back. I wasn't in my office that day when it reversed here by the 50 day. And then all of a sudden now it's at 2013. And, I did think I had a good sale here, but I didn't get back in. So how good was that sale if you want to be in Yahoo for the whole year, because you think that, according to the weekly chart, we're going to see a move to 23, 24, which I do think that could happen. Okay, I do think that at some point this year, this stock's going to be 24 to 25. So if you do think so and you're not that active, if you exit it, you got to make sure you get in, or you stick around a little bit longer. So with that said, whatever, that's Yahoo. You go back to the banks real quickly. Goldman Sachs, entry right here, entry right there, still looks good. But it's extended from the 8 day, extended from the 21 day. So it's not a spot to just buy, spot to maybe let it sift out. Let money hopefully rotate other places while this builds another new level, so to speak, because it happened here, then it happened again. It actually happened again right here. So right now with Bank of America maybe under a little pressure and Goldman a little off the highs, it can go a little sideways, so it's not on your A play anymore. JP Morgan, the same thing. It's just not an A setup. There are A setups when things happen. If you guys remember, when Bank of America broke above 10, I said right around, what was this, 41.45. I'm like, this is your spot. 41.49, I remember it very well. I'm like, this is your spot to buy. If it goes above, you add. And since then, it's had a really nice move. Okay, and then it followed the 8 day here. It closed above the 21 day, so it didn't get you out. And then since it's following the 8 day again. So you want to be a little cute, and you want to draw an accelerated uptrend line. Here it is. And, I would continue to stay with it. Don't let the bears just get you out of your stock because they think you have to be. So here's actually two trend lines. So if it's following the really, I would say, strong or highly elevated trend with the 8 day. If it were to break below this, then maybe it comes in and tests this level, which if you sold here and you think you want to save yourself some money, you buy back here. But still, that hasn't even happened yet. Go to the home builders. Still look good. Really nice tight breakout. Here you go. No pulling at all today. Nice leadership above the 8 day. It's above the September highs. Stocks within this group still look good. You look at the industrials. Look at that. Clean breakout at highs. Didn't come off the highs. Let the 8 day catch up above. It's well above. Look at this is where the September highs. This looks a lot like the XLF. Here's your gap from the beginning of the year, and there you go. A lot to like. A lot going on in there. Qs are a little different. Qs, still look where the September highs are. We're well below, but a lot of that has to do with Apple. Today, it tried to cross above and didn't have much power because Apple was weak, and then Intel was after the close. And then people said to me today, Red Dog, what are you going to do with your Intel? Because you don't really take stocks into earnings. I said, you know what? If Intel was at the dead lows, I would be a little bit more comfortable taking it into earnings, but because Intel had a nice 2-3 week rally from the lows, it needs to be really good for it to continue. It's not worth my time, and it's not even worth an option play. So they sort of leave the virtual trade floor today because this was a nice move. All right, I started looking at this when it cleared this area right here, and I know it was very, very choppy. Remember, right around this day, came in, came back, and then it was pretty clean in here. On this gap up, I said, you know what? I'm going to use my swing trading gap rule, get involved. Here it kept going. I don't think I added here, but I held it, and then into today, I'm like, you know what? It's been a big move. I'm not going to take it into earnings. I'm just going to let it go. And I think it was up after hours, and now it's off a little bit, so we'll see what happens there. GE, also kind of interesting the way it went. We've been holding it in this area. Remember, we've been talking about it and holding it. I was hoping that it would break out from here a few days ago. Finally, it went today. So at least it gave us a little bit of cash flow to buy it around 21.10-ish. That's where we started. We could have added a 21.25. It did hit 21.54 into the close. What I did is I didn't want to be long the stock because I don't have no idea what the earnings are going to be. I do know that it's well off the highs, so they're not expecting much. Last quarter was bad, and they guided lower, and it got, crushed to the downside. So a lot of people thinking that might be the same. So for me, I'm like, you know what? I'll sell the stock and I'll hold some options. There's really no premium in there. But again, if you're going to do weekly options into an earnings report, if the earnings are bad, you're risking everything that you put into it. So you risk a few $1,000s. So this way, if it does report something good, and goes to 22-ish or a little bit above, you can make a double or a triple in your options, and at least it's calculated. Because I know that if it comes out good and I sold my stock and I'm a little upset that it went there without me, I would be a little upset because I didn't take the risk into earnings. So I took a little bit of risk. But again, I bought those options knowing that if GE misses, there could be zero tomorrow. It's fine. I'm not looking for a home run. I'm not putting a lot on the line. I'm risking like a tier 1 trade. That's it. So anyway, with that said, that's GE. As far as some other groups, I want to talk about the IYT. IYT, people were talking about getting long it today. I'm like, what are you talking about? Look at this channel. We've talked about this at the morning call. I think we had it on off the charts. This is an unbelievable, beautiful channel. Okay, this was your breakout. Came back, retested. Even if you didn't get that at the start of the year, boom, huge gap up. And now look at this move. Okay, from 92 to 101-ish. That's about a 9-point move in the IYT. It's even more than what I would have thought the measured move is, because you go from 86 to about 92-ish, it's 5 points. It didn't go 5 points. It went more than that. So at this point, do not buy the transports. If anything, wait for a pull-in and look for some kind of cute short if that's what you do. But, people have been trying to short this, they're getting crushed. But overall, look at this calculated technical move of something like the transports. It's helped lead the way. I was looking at, the commodity index. I think DBC, because I put it on today, a little similar. Not exactly the same type of scenario, but you do have some wedge type formation here. So I got a little bit, and we'll see if at some point it breaks above and continues. Apple, definitely disheartened. A lot of people were thinking maybe this was it, that it was going to be different, but Apple did exactly what Apple's been doing, giving you a day or so to trade it and then kind of failing. Is it because everyone thinks it's going to be pinned at 500 because of option expiration? Maybe. Is it because it's still in a huge downtrend being controlled where it couldn't even get up to? I think more of that, but a little bit of everything. So for us, I did not take it home long into the DeMarc call because this was giving me no reason to take it home long. That day it opened up, gave you a nice little entry around 495. Another entry when it went above the 498-ish. And then, I know I sold it long around 503 and said that's a good trade, cash flow. Today, it opened up. Some guys even tweeted to me like, I used your red dog reversal. When it opened up and went back below 509.44, I shorted it and put my stop at the high of the day, 510.75. I'm like, that's a nice setup. You don't know. At least it's calculated. So I actually shorted it too. One trade today. I made one trade in Apple, believe it or not. And that was right here. You go to the open, okay, and it was right around, I don't know, this was that low. It must have been right around here. It opened, failed right away. I saw it trade right below this point. Shorted some around, I think, 509, traded into the gap, or somewhere around here. I covered some and I made a few dollars. I'm like, you know what? I don't know if it's going to go negative. It was a gap up. I actually got to get it off this time frame so you could see it a little bit better. Let's see, tools, lines. I got to get somebody in here to do that for me. But whatever. Bottom line is, had a little bit of a short, and I heard people all day long all frustrated about Apple today. And I'm just happy I didn't go back to it. And at this point, this doesn't look like a blaring bounce, a blaring commitment, a blaring bottom. This looks like another little 3-day up move as it's been oversold, and I would still wait for it to prove itself more. We've had many bounces along the way, especially from the upper end area, which was, remember when it first broke the 21-day, that was your out. That's when we talked about it on Kramer, saying now it's just a trade. Let's try it at the 50-day. Tried it at the 50-day, little 3-day bounce, failed. This was the 100-day, okay? If you put it in, because I do remember it, let's see if Red Dog's right there. Basic studies. Let's go basic studies, moving averages, Go to your 100-day. I remember that 100-day gave another little tiny bounce, but it was even more short-lived. Yeah, here's a 100-day. Just missed it. You know, gave you a nothing bounce, then came retested it, and people said, oh, double bottom, so it had a little bit more power. But what did it do? It fell to the 21-day. Then once it closed below it, it never really reclaimed it, and then boom, all the way down to the 200-day. Remember when it wouldn't bounce off the 200-day? I'm like, you know, my 200-day rule, if it doesn't bounce off it with, or it's not a sell trap or a bear trap, get out of the way and then pow. Then finally, this was a nice move. Why not? From 700 to 505, gave you a red dog reversal with a nice entry here at 522. Then you had your first gap and go. And then what did it do at least the second day? It held a decent percentage of it. And then I remember adding here, and then it just came in really hard. And since then, it's been a methodical, or not even a methodical, it's just been a mess, really, with a lot of noise in the middle for guys to go long and short, but no traction. So this little 3-day move tells me that nothing has changed yet. So with that said, we'll be able to look at what goes on after option expiration, because then the fix isn't in anymore for the call buyers and the put buyers. If the dealers win at 500, I think it's kind of funny that they still could do that, but I wouldn't just bet your trades on that. And then earnings are next Wednesday. So we'll see where we are as we go into earnings and then figure out what type of option trade we might want to do. I'm not going to get into that now, but as of right now, it's really just, cash flow trades back and forth, levels versus levels, and no opinions. Google got a little weaker also. At this point, I would think that it's just, I don't know, if you look at this trend from here, kind of broke it. You look at the 21-day, which it's been riding and holding. This is the first time I closed below it. If I was in Google trying to trail it and stay with it, this would have been my out day. This is when it broke the 8-day moving average right here. Your first signal that there's a little bit of trouble here if you're an intermediate momentum trader. And this would be at least get out of some as it broke the 8-day. Okay, and then now it's below this trend line, below the 21-day. It's weaker than stronger, but that's the way a lot of high beta is right now. So we'll see how it acts when it gets to the 50-day or this little support zone. We still have a week or so until this earnings comes out. So it's just kind of flapping in the wind. So don't be too enamored with it. Amazon still hangs tough. Okay, here was the prior high. Here's your descending channel, resistance. Turn tail right at the support, and now it's hugging above the 8-day. Still looks decent. I would not have any type of size here. Earnings are going to be coming out next week or so. Get you the exact date on Tuesday. But right now, trading-wise, it's still okay. eBay, I know some people were upset with because it didn't have much traction today. But, eBay is a choppy trade where it doesn't really give you that much traction. Even here, last time it gapped up, did nothing for a while. So here, at the highs, was a great report, but gapped up. It might need to hang out here for a little while and chop everybody up, which is unfortunate. Typically, you get like 2 days in eBay, and then you get chop suey. And, here was the descending channel, closed strong, gave you a gap up, and then since then been just chop suey. Now, who knows? Maybe it's going to have to go sideways for a while, and use today's low tomorrow as a gauge, because it definitely does like to chop you up. So the investor that's giving it space, that's maybe using the 50-day, goes, look, it hasn't, broken the 50 days. One time it tested here, one time tested here, here it didn't even get there. So it's trending nicely for a macro investor, okay? But as a trade, they're far and few between. Gold, I would have liked to hold up a little bit better. Still not giving guys what they really want. I know for me, on this, gap up, I got long a little bit. I held it through these few days. Today, it did try and get above 163 with some force. Got as high as actually 164.40, and then failed right around this 50-day. So it closed okay. I would have liked to seen it close a little stronger. So at this point, I'm going to stay with the trade. And now I really, this has to hold above this area. I'm hoping that it stays above 163 to then have an even chance of taking out this trend line. But overall, I talked to the gold guys out there, the bugs who are waiting for it to actually take out the 1800, and they were a little excited today, and it turned out into a decent trade. But if you added on strength, you got hurt, which is what's been going on with gold, except for that July move that we saw that finally gave you a quick move. But look at what happened there. It was a lot different. really big gap up, closed on the highs, gave you another move. This one accelerated, closed, and right here it's still in no man's land. So we'll see. So with that said, today was a nice breakout day. Was it powerful? No. Was there a huge amount of volume? No. But that's the way it's been, I feel like, for the past few years. There's not a lot of volume, and the trade is a little different. What kind of works when we're in this intermediate uptrend is either you have to be like a micro scalper and find the perfect setup and make a little cash flow, or you have to really take a portfolio approach with 4 to 8 stocks or 8 to 12 stocks and hold them with a little less size, give them more room so you're not enamored by the noise. And then when you do get that price pattern that you would have just as an active trader traded at that particular point, you add to your existing position, so then when it breaks out, you could then sell what you would have made if you were flat for cash flow, and then you're back in your swing position and you let the market trend for you while it's trending. Every time you get to extremes, you put on some hedges. Like today, to me, this was a bit of an extreme, so I put my hedge back on. And then this way you could sleep at night. If we open lower, then you can cover some of your hedge. You could look at what's acting well. You add to what's acting well, and then next time we have strength, you short into strength, you trim your longs, and you keep doing it until all of a sudden one day you open down and the market doesn't support it. There's no commitment higher. You use that as a high-level stop. You get out of the way. We close below moving averages that we never closed below. That gets you even more out of the way. And then ultimately, you went from 8, 12, 14 positions back to 2 or 3, or even sometimes back to cash if all of a sudden the condition of the market warrants a bit of a correction. And then from there, you could be trading from a net short position or back to tactical. Remember, we talk about portfolio or tactical, and that's where you're just really day trading and you're shorting stuff, and there's no reason to have risk on until you get some type of reversal strategy, and then the trend changes again. And I'll do that cycle over and over and over again, and it'll never be the same. There'll be different stocks that are strong, there'll be different speed, it'll always be changing, but if you're in the right frame of mind, you'll be able to see it versus complain about it, because I see a hell of a lot of complaining out there, which gets you nowhere, because it kind of blinds you to what's really going on. So it's Thursday. I'm not in tomorrow. I'm going to be on a plane on the road on the way to South Carolina. I'm going to Charlotte. Where am I going? Charleston, South Carolina. It's my niece's graduation. So my parents are going. My family's going. Market's closed Monday, so we're taking a 4-day week. I will be on the Twitter sphere probably early in the morning, maybe on the virtual trade floor to manage some positions because my flight's not till 12. So I'll try and do everything I can to keep everyone informed in a way that is prudent and conducive to what's going on out there. So Thursday night, have a nice night, go for a drink, happy hour, do something that makes you happy, and then tomorrow's Friday, and look for those GE earnings, and we'll see what happens, as far as whether or not they're decent enough to make us some money on the options, or if it's just going to be money out the window, which when you do options, 95% of them, if you go with straight buys or straight sells, that's the way it is. That's why you're actually probably better off having stock using covered call strategies or collar strategies, and that's probably the better way to go. But into earnings, I'll do it every now and then. So again, have a good night. Scott Redler, Chief Strategic Officer at T3 Live, and I will be online. I won't see you at the morning call, and I'll see you back on Tuesday with Brittany.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.